Hey, welcome back to Tesla Shorts Time Daily, episode 431, coming to you from a gray and drizzly Vancouver this morning. It's April 9th, 2026. Grab your coffee. There's actually quite a bit moving in Tesla land today, some of it quiet and strategic, some of it loud and competitive. Let's start with something that feels like the end of an era, even if Tesla is treating it as just another logical step. Production of the current generation Model S and Model X has now officially ended. Custom orders were quietly pulled in early April, and what's left is only a few hundred factory inventory units, most of them plaid versions that are now moving quickly around the world. After more than a decade, these cars, the ones that basically proved Tesla could build serious luxury performance vehicles, have reached the end of their current life cycle. I've been thinking about this one a fair bit. On one hand, it's a little bittersweet for anyone who remembers the excitement when the refreshed S and X dropped with the yoke, the new interior, and that wild acceleration. Those cars carried the brand's halo for years. On the other hand, this is classic Tesla. They're not sentimental about platforms once the volumes no longer support keeping a whole dedicated production line running. Shutting it down frees up meaningful manufacturing space and engineering bandwidth for whatever comes next, whether that's a true refresh or an entirely new flagship platform. It also quietly signals to the loyal owners who've been waiting that something is coming. The company has always been willing to sunset even its once iconic products when the math stops making sense, and right now the math is clearly pointing toward newer vehicles that can be built at higher volume and lower cost. It's a disciplined move, even if it leaves a small group of customers scrambling for the last few plaid inventory cars. While one chapter is quietly closing, another big one is opening on the autonomy side, and the news out of Europe today is genuinely significant. Regulators in both London and Berlin have cleared Tesla to begin unsupervised full self-driving pilot programs in those cities. This isn't just another minor approval, it's a real expansion of autonomous testing into two dense, complicated, historically tricky European capitals. The fact that officials in both places are now comfortable enough to let Tesla run unsupervised pilots, even under strict initial monitoring conditions, says something about how far the latest FSD stack has come in their eyes. The data that will come out of these environments is going to be pure gold for Tesla's training. London's black cabs, red buses, narrow streets, cyclists, and unpredictable pedestrians paired with Berlin's aggressive merging and complex intersections will throw situations at the system that simply don't exist in the same volume in Phoenix or Austin. That real-world feedback loop should accelerate improvement noticeably. From a competitive standpoint, it also puts more pressure on traditional automakers who are still iterating on more conservative Level 2 driver assist systems. For Tesla's longer-term robotaxi ambitions, this feels like a meaningful regulatory win that moves the timeline forward, even if only incrementally. The community reaction has been the usual mix. Lots of genuine excitement from owners who've been waiting years for this, alongside some very reasonable calls for Tesla to be extremely transparent about safety metrics and incident reporting as these pilots scale. That balance of enthusiasm and healthy skepticism is healthy. Speaking of faster progress, the latest software update is already making itself felt in people's daily drives, and the difference sounds pretty tangible. This version of full self-driving brings noticeably quicker reaction times to both static objects and sudden events on the road. That translates directly into smoother rides and what a lot of owners are describing as a higher sense of perceived safety. It's another step forward on the vision-only, end-to-end neural net approach that keeps learning from the millions of miles the fleet is driving every single day. For everyday customers, especially those using it in urban environments with lots of intersections, pedestrians, and unpredictable traffic, this kind of improvement matters. It reduces those little moments where the car used to hesitate or brake more aggressively than a human would. From Tesla's perspective, these incremental gains in smoothness and responsiveness are exactly what helps close the gap to the regulatory comfort levels needed for unsupervised operation in more markets. These leaps can feel small in isolation, but they compound powerfully over time, especially when you have the data advantage Tesla does. Every mile driven is another training example, and the gap between Tesla and everyone else on real-world data just keeps widening. It's not flashy headline material, but this is how real autonomy actually gets built. While software keeps marching forward, the charging side of the business is getting some welcome new transparency that tells an interesting story about how this network actually makes money. Tesla has released an online calculator for its Supercharger-for-Business program that lets potential host partners see the full cost of installation and then projects returns based on expected location traffic. The spread in outcomes is dramatic. Some well-chosen sites look like they can pay back in well under a year. Others, even after several years, are still struggling to reach break-even. That kind of visibility is useful for everyone. For Tesla's energy business, it really underscores how critical smart site selection is if they want to turn charging from a convenience feature into a reliable profit center, especially as they continue opening the network to non-Tesla EVs. For the broader industry, it's a reminder that location intelligence and foot traffic data are going to be what separates the winners from the also-rans in the expanding public charging market. Not every parking lot or highway exit is created equal, and the numbers now make that crystal clear. It's the kind of pragmatic, data-driven move that feels very on-brand for Tesla. Location and timing matter enormously in charging, but right now the competition is getting very direct with Tesla owners in a different way. Polestar has rolled out targeted discounts of up to $21,000 on its 2025 models, and these incentives are aimed specifically at current Tesla owners. That's a pretty aggressive conquest play. It reflects how intensifying the competition has become in the premium EV segment, where switching costs are dropping fast as more brands offer adapters and better charging access. For Tesla, this is a clear sign that rivals now view its customer base as prime territory for poaching. It also shows that price competition is evolving beyond just new vehicle MSRPs into these very targeted data-driven incentives. Over time, that could put some downward pressure on Tesla's used vehicle values and even test loyalty for owners who get tempted by a big discount on a car with more traditional switches and a different driving character. It's not an existential threat, but it's another data point in a market that's becoming more competitive at every price point. Price pressure isn't the only new threat appearing. On the heavy-duty side, Windrose has just delivered its first global E700 electric long-haul truck here in the United States. This thing packs a massive 705 kilowatt-hour LFP battery and can charge on 2 CCS plugs at the same time, giving it serious range and speed for a Class 8 tractor. The fact that a Chinese-built competitor is already delivering vehicles months before Tesla's Semi reaches real volume production is worth paying attention to. This delivery accelerates the timeline for heavy-duty electrification in North America in a very concrete way. It puts immediate pressure on domestic OEMs to match both range and charging speed. For Tesla, it means the Semi will need to prove clear advantages in efficiency, software integration, over-the-air updates, and especially its service network if it wants to maintain a leadership position. Chinese entrants are moving fast, and the bar is rising. That leads nicely into a bigger picture thought that's been on my mind lately. Taking a step back from the daily headlines, it's worth examining what actually determines whether battery electric heavy trucks become economically superior to diesel for most freight routes. The surprising truth, at least for people who focus too much on sticker price, is that the break-even point is driven far more by annual mileage and electricity price than by the upfront cost of the battery pack itself. Real-world trials have shown that trucks covering high annual distances at electricity rates below 20 cents per kilowatt-hour can recover the higher capital cost within 3 to 4 years through fuel and maintenance savings alone. Routes that let trucks return to a depot predictably every night open up even cheaper overnight charging rates, which widens the advantage further. From a pure physics standpoint, electric drivetrains are simply more efficient. Roughly 3 times as much energy makes it to the wheels after you account for thermal losses in a diesel engine. Tesla designed the Semi from the ground up around a dedicated electric chassis rather than trying to convert an existing diesel platform, which helps keep weight and efficiency penalties low. By controlling both the vehicle and the charging infrastructure, Tesla can optimize duty cycles and energy contracts in ways that third-party operators simply can't. Add in the company's massive battery production scale that keeps driving cell costs lower every year, and the picture becomes clear. For high-utilization fleets with access to cheap electrons, electric trucks are already winning on total cost of ownership. The Windrose delivery is a reminder that the race is on, but the fundamental economics still look favorable for well-executed electric platforms. Staying on the practical side of EV ownership, one of the biggest daily frustrations for a lot of drivers is finally getting some meaningful relief. Walmart is expanding high-speed EV charging at dozens of its stores across North America. This directly tackles the where do I charge barrier that still sits in the back of many people's minds, especially on longer trips or in areas without dense supercharger coverage. By putting chargers at retail locations that already see heavy foot traffic, it turns shopping time into productive charging time in a very natural way. For Tesla owners, this adds another reliable, convenient option beyond the supercharger network. It could meaningfully ease range anxiety in suburban and rural corridors where destination charging has always been a bit patchy. The development also shows traditional big box retailers quietly becoming real players in the charging ecosystem. A lot of Tesla drivers I've heard from are genuinely welcoming the extra options, particularly in places where superchargers tend to be busy during peak hours. If Walmart keeps scaling this, it could quietly grow into one of the largest non-Tesla charging networks in North America over time. Practical moves like this are what slowly but surely make EV ownership feel more normal for regular people. Back home in Texas, things are a bit more mixed for Tesla at the moment on the incentives front. The company isn't getting the complete package of local incentives it was hoping for on expansion projects around Austin. Local officials decided against granting the full request, which sparked some headlines about possible friction between Tesla and its home turf. The outcome means slightly higher costs for future growth in the area, although it doesn't appear to threaten existing gigafactory operations in any serious way. This is a useful reminder that even a company as large and symbolically important as Tesla still has to navigate local politics and budgeting realities when it wants to scale infrastructure. Tesla has successfully handled similar situations before by emphasizing the jobs it creates and the long-term economic impact it brings to a region. Given the company's current scale and cash position, it's well positioned to absorb the incremental costs. Still, repeated friction in its own backyard could slow strategic investments if it isn't managed carefully. The key will be how Tesla continues to frame its contributions to the Austin area going forward. Those regional differences are showing up in sales numbers too. Tesla recorded a sharp jump in South Korean registrations recently. The increase was driven largely by demand for vehicles that combine strong real-world range, fast charging, and advanced driver assistance features. Even in a fairly mature EV market, buyers still seem to prioritize software capability and everyday usability over other factors. That validates the staying power of Tesla's core product strengths, even as local and global competitors ramp up. For the broader industry, it suggests that feature gaps, not just price, continue to play a major role in who wins premium EV sales. And that brings us to the bigger global picture. BYD and Tesla are hitting different kinds of headwinds as both try to scale their operations internationally. BYD is feeling real margin pressure in many overseas markets, while Tesla is dealing with slower growth in certain regions. The contrast shows how each company's approach to vertical integration and product mix creates its own unique vulnerabilities. For Tesla, it reinforces the importance of maintaining clear technology leadership and tight cost discipline while low-cost competitors continue to expand. The story illustrates that the EV race is becoming less about raw volume in every market and more about sustainable profitability in each individual geography. On the incentive and regulatory side, the Austin situation is one to keep an eye on. Future factory expansions and infrastructure builds can be surprisingly sensitive to local tax breaks and permitting speed. While Tesla is positioned to handle the higher costs, any repeated friction in its home territory could complicate longer-term planning. That said, the company has a track record of eventually winning these conversations by focusing on jobs and economic contribution. It's a good reminder that even the most innovative companies still have to operate inside real political and regulatory systems. Cathie Wood's ARK Invest continues to show real conviction, adding another $11.4 million worth of TSLA shares recently. That accumulation stands out at a time when some other analysts are showing broader market caution. It reflects a long-term bet on autonomy and energy storage growth that quite a few serious Tesla watchers still share. The move is being watched closely on both sides of the bull/bear divide. Finally, over in Australia, Mazda has launched an aggressively priced CX-60 electric SUV that undercuts the Model Y on starting price while offering competitive range and a more traditional premium interior with actual physical switches and a head-up display. Early orders are reportedly strong, which shows how legacy brands are finally bringing compelling alternatives to market. On Australian forums, Tesla owners are actively debating whether those more conventional features will pull some buyers away from the minimalist Tesla experience. It's another data point in what's becoming a very crowded and interesting midsize EV SUV segment. Before we wrap up, keep an eye on how those unsupervised FSD pilots in London and Berlin generate their first batches of dense urban training data. That real-world feedback could accelerate regulatory progress in other markets faster than many expect. That's your Tesla news for today. TSLA closed at $343.25, up $2 or 0.6%. If you found this useful, a rating or review on Apple Podcasts or Spotify really helps new listeners find the show. You can also find us on X at Tesla Shorts Time. I'm Patrick in Vancouver. Thanks for listening, and I'll talk to you tomorrow. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.